Gold's now saying, I'm gonna beat the S&P. I'm gonna head into a trend. We think silver's gonna do something extremely dramatic, and it's gonna do it in the next handful of months. We'll probably see $200 by the second quarter. Now, I could be wrong. We might vastly overshoot and see something even higher than that. Seriously. So I'm open to that possibility. So I do not have a precise target. I have a ballpark target. And I think the minimum end of that is about 200.
Gold will keep doing better than the U.S. bonds, stocks, and the greenback up until 2026. And that is why one of the biggest banks still has its highest allocation and advises investors to purchase the precious metal on the dips. The S&P 500 has risen approximately 16% this year, placing the index marker on track to record its third consecutive year of 10 or more % profits. Michael Oliver says gold is the giant of financial metals. He points out the technical change in the gold market that is severe, and especially in its gains as compared to S&P 500. He observes that gold has now scaled out of a long-established trading range, and the stage has been set to start a multi-year long bull market. This outburst indicates that the gold will be the most profitable tool in stock market, and there would be much more than what is estimated. Let's dive into today's video to uncover some valuable insights. Don't forget to subscribe and hit the notification bell so you never miss an update.
The mama market of the monetary metals, and so far over the last 5 decades, it's been a leader, okay, in terms of dimension of gain since 75, when it was 100, and 76, it had a corrective low at 100. Start from there, we're 4,400, okay? You do the math. But something big just happened in November. And it wasn't up in gold or up in silver. Yeah, that happened. But that's been going on for a while. Gold's been in a bull market for a while. But something new happened. And that is that an asset class shift was signaled. The chart on page 4 of my weekend report, it shows what we call a spread relationship between gold and the S&P 500, meaning at the end of every month we plot where's the front month contract of gold divided into the S&P, express that as a percent. Okay. And we know in 2011 gold peaked, and in 2013 it particularly started to collapse toward the 2015 price low. And in that process, its performance relative to the S&P was also dropping. Okay. And so the top chart on page 4 shows that spread collapse, where we were dropping from like 80% gold versus the S&P to down to close to 50 at the end of 2015, which is when gold actually made its price low. But then since that 2014-15 period there, where it dropped down near 50% of the price of the S&P, you could draw a line sideways if you want to. And we've been oscillating either side of that. But actually there's been a slight gradual downtrend line on the spread chart. A technical feature, okay? And you can see 1, 2, 3, 4 rallies. Back in April, we hit that line again and dropped back, April, May, June. And then in November, last month's close, gold closed on a spread basis, relative performance, out above that structure, meaning I'm breaking out. Okay, now, this is a beginning sign. This is not what happens late in a trend. This is saying, hey, you think you've seen a bull trend to date? It's just beginning, because the asset class shift is commencing now. It's no longer a duel between gold and the S&P, which basically has been sort of oscillating sideways for 10 years, where whether you bought gold or S&P, it did about as well. Okay, gold's now saying, I'm gonna beat the S&P. I'm gonna head into a trend. But given the size of this base, 10 to 11 years wide, and the depth of it, you're not going up for a month or two on this performance. You're going to go up for a couple of years probably. But it just broke out. So that the people that think, hey, gold's been going up too long, it's got to go down some, got to correct. This technical indicator here says, no, it just began.
The gold to silver ratio of how many ounces of silver do you need to buy a single ounce of gold has gone down significantly since the 2020 high of 108 to the current 65. This normalization implies that silver can continue to provide relative value relative to gold, in spite of its remarkable run. The average gold-silver ratio was approximately 66 since 1971, and the lower silver bull runs in the past amounted to a gold-silver ratio of less than 40. Should the same trends be repeated in the past, Silver will experience a significant further rise against gold, and this may be one of the reasons why analysts predict silver to be at $100 in 2026. Michael Oliver estimates that there will be an unprecedented increase in silver prices, as high as $200 in the second quarter. Oliver refers to the gold as already taking the lead, but now silver is taking the center stage. That is not to say that gold and gold miners are weak, it is just that silver and silver miners, which have been so underestimated, are now well positioned to perform better. Now let's jump straight into the content.
Yeah, now silver relationship to gold is also been subdued, like this chart here, especially since 2020. Remember, both metals had a big surge in 2020, from early that year through later that year. Silver like doubled in price from 15 to 30, and gold went up 40%. So silver beat gold on a percent basis. But since 2020, silver's performance to gold has languished. It's pulled back. So have the miners versus gold. Now, that doesn't mean they were going down. It just meant they weren't going up as much as gold was, okay? But that started to change. And early this year, silver started to really ramp on the upside. It's a signal we put out to our subscribers based on other technicals. And the performance upticked. And on the November close of the spread versus silver versus gold, you also had a breakout of a multi-year base. So not only did gold say, hey, I'm on top of the game versus the stock market, silver said, now I'm going to outpace you, mama metal. Silver is coming up from depths. And its depths are pretty deep, meaning you got down as low as 1%. Divide an ounce of silver to an ounce of gold. And if you go back 50 years, that's low. It's been there before, but that's it. That's the low, okay? And we've now since surged, and it's broken out as of November. Now, back in November, where did silver actually close in price? $56. Okay, 2 weeks and a day into the new month, we're $64. Wow. Okay, something happened, and it wasn't just that silver was going up. It's been going up for a couple of years, like gold, right? Okay, but the spread broke out, and once that spread broke out, it told us if you're going to go into monetary metals, emphasize silver and silver miners. Doesn't mean the gold miners are no good or gold's no good. It just means silver and the silver miners, which have been languishing and vastly undervalued compared to their peers, are now ascending, and they're going to be on the top. And that's what's happening. And we think silver at minimum is going to at least reach 2% very quickly of the price of gold, meaning from where it was at the lows back like in April, it's going to double in value relative to gold. Not double in price, double in value. So, and the gold's going to be going up during that time. It has been. But silver's going to outpace it.
After a stellar run in 2025, the outlook for key industrial and precious metals is shifting from one of broad-based optimism to a more complex and volatile mix of structural support and cyclical risk. Gold, silver, and copper all enter 2026 with compelling long-term narratives, but investors may need to brace for choppier price action as macroeconomic, political, and technological forces collide. Do you think 2026 will reward long-term metal holders, or will short-term volatility shake out weak hands first? We'd love to hear your thoughts in the comments below. If you enjoyed this video, give it a thumbs up and make sure to subscribe for more updates. Thanks for watching.